KCC Amit Kumar, and I'll discuss IFRS 5 non-current assets held for sale. Now, what if we plan to sell any asset within 1 year? Can we continue to show it as part of our fixed assets, as part of our property, plant and equipment? So IFRS says that when you plan to sell any asset within 1 year, you have to show it separately under current assets category. Why current assets? Because you plan to sell within 1 year. You should be committed to sell it. So your planning does not necessarily simply allow you to record it as part of your current assets. You cannot change it. The asset should be immediately available. Immediately available means that you have 5,000 pending orders and you are saying that after these 5,000 pending orders are complete, we plan to sell this factory. That means the asset is not immediately available. Or you say that we are going to use this office building for next 3 months and then we'll sell it. The asset is not immediately available. If it is vacant, if it is immediately available for sale in the current situation, it is available for immediate sale. I'll use the term available for immediate sale. It has to meet this criteria. You are locating a buyer, you're advertising to sell it. You started locating a buyer for the asset. The entity has no intention to change the plan. When all these criteria are met, you're required to reclassify the asset from property, plant and equipment or an intangible asset into non-current asset held for sale. So when you do it, so IFRS 5 says that you have to reclassify the asset at lower of cost or net realizable value. One important word which they use is on existing measurement basis. This simple word has a lot of weightage in IFRS 5, on existing measurement basis. What does it mean? That if you have been using cost model and your asset was worth 250,000 on 31st March 2018 and on 1st July or on 30th June you plan to sell this asset within 1 year, you need to calculate the depreciation till date and arrive at its carrying amount on 30th June. That is measuring it on existing measurement basis. Suppose there was a depreciation charge every year was 50,000. And this is net book value. Net book value. The carrying amount on 30th June will be 50,000 is for 12 months. Till 30th June, it is April, May, June into 3, 12,500 is a depreciation. The carrying amount on this date will be 2,50,000 minus 12,500. This is the carrying amount on existing measurement basis. You have to compare it with recoverable amount. or you can say net realizable value. Because recoverable amount in this case is recoverable amount is higher of value in use and net realizable value. So we'll not use the term recoverable amount, we'll use the term net realizable value because there is no sale. Hope you remember it from my discussion on IAS 36 impairment of assets. That recoverable amount has two things within it. It has to be higher of value in use and net realizable value. But in case of IFRS 5 non-current assets held for sale and in case of inventories, there is no value in use. The only word left is net realizable value. So we compare directly carrying amount with NRV. Now this is fair value less cost to sell. NRV means fair value less cost to sell in this case. And fair value less cost to sell in this case may be suppose 240,000. So on the date of classification, non-current asset held for sale will be recorded at 240,000 and the difference, will be recorded at 237,500 in this example. But what if net realizable value is 230,000? So non-current asset held for sale will be recorded at and there will be an impairment loss recorded of 7,500 in P&L account immediately. This is how we'll treat something which is on cost model. If it is on cost model, we'll bring it on existing management basis, means depreciation till date, and then we'll compare it with the fair value less cost to sell, and whichever is lower, so it has to be recorded at on existing management basis lower of on the date of classification, on the date of classification it has to be recorded at lower of cost or NRV. So we have to bring it on existing management basis, carrying amount on existing management basis. Carrying amount on existing management basis. If the existing management basis is cost model, we'll bring the carrying amount on existing management basis at after charging depreciation till this date. What if we are using revaluation model? What if we are using revaluation model? In the same example, if this was the situation and fair value less cost to sell is fair value is 260,000 less cost to sell is 5,000. So fair value less cost to sell turns out to be 2,55,000. This is the value. And on 30th June, the entity decided to reclassify the asset as non-current asset held for sale. And I've said to you that on the date of classification, we need to value it on existing management basis. So can you tell me the carrying amount? Can you tell me the carrying amount on 30th June 2018? Can you tell me the carrying amount in this situation? Please have a look. Revaluation is done at fair value. Revalued amount is the fair value on the date of revaluation. Can you tell me what is the accounting to be done on immediately before arriving at the carrying amount, and then we'll compare on the date of classification? What is the carrying amount on existing management basis? Can you help me? What is the carrying amount on existing measurement basis? On the basis of the discussion we had in revolution model, please can you discuss? If the carrying amount is 250, depreciation per year was 50,000. If the fair value in the market is 260, so in the revolution model, first we need to charge depreciation till 30th June. If we charge depreciation till 30th June, the carrying amount after depreciation on 30th June 2018 is equivalent to same as what we did for cost model. After charging depreciation of 12,500, it turns out to be 2,37,500. So this is the situation of the asset till 30th June. Now, since our existing measurement basis is revaluation model, since our existing measurement basis is revaluation model, we need to perform revaluation exercise as well. If you perform revaluation exercise on this day, what should be the value? What should be the revalued amount of this asset? What should be the revalued amount? Fair value is 2,60,000, less cost to sell 5,000. Revaluation is done on fair value. So I'm stressing on these points because you also have to be careful when you're reading the content in the question paper. Do not mistake it by taking 255,000 as the revalued amount. It is revaluation is done on fair values. Fair value is 2,60,000. It is not less cost to sell. There's a difference between the two. Fair value and fair value less cost to sell are two different terms. When revaluation is done at fair value. So the fair value on the date of classification is 2,60,000. So the revalued amount is 2,60,000. How much will go into revaluation surplus? 2,60,000 minus carrying amount immediately before revaluation. 22,500 will go into revaluation surplus. 2,37,000 is the amount immediately before revaluation exercise. Now, do we have the carrying amount on existing measurement basis? Carrying amount on existing measurement basis on 30th June 2018 now is 2,60,000. So next step of classification comes after it. So hope you have understood the difference between carrying amount on existing measurement basis under cost model, carrying amount on existing measurement basis under revaluation model. It says that we need to arrive at the carrying amount on existing measurement basis means that if you're using cost model, charge depreciation till that date. If you're using revaluation model, charge depreciation till that date, but also perform revaluation exercise and arrive at the new revalued amount on 30th June. Is this clear till now? Till this point, is this clear? Anyone in doubt? Is there any confusion? Panu, Hema, Nitika, Shitesh, Uday, Pankaj, Sapna. Any doubt? Till now? Even one confirmation will make me believe that everything is perfect and going fine till now. Perfect. Now comes the date of classification. On the date of classification, we need to compare carrying amount on existing measurement basis with fair value less cost to sell, and lower of the two is recorded as non-current asset held for sale. Now at what amount I'll be recording non-current asset held for sale now on the date of classification? What is the amount? Can you tell me the amount? This is my situation revalued amount. This is carrying amount. Fair value less cost to sell on this date is 2,55,000. 2,60,000 is the revalued amount. Carrying amount on existing measurement basis. On the date of classification, we need to compare. And after comparison, whichever is lower, we'll take that amount. It's like a Pakistani soldier who was caught by Indian army, and before he is handed over to Pakistani army, he is in no man's land. So till the time he is in India, he has to obey the rules and principles of India. So till the time he is not crossed the border, he has to follow the existing measurement principles. That is, IAS 16 property, plant and equipment principles will be followed till the time the soldier crosses the border. Now on the date of classification, this is no man's land. This is not belonging to IAS 16 property, plant and equipment. This is not belonging to IFRS 5. This is no man's land. No rules are applicable here. So in this no man's land, the requirement is that lower of the two, what is coming in from IAS 16 property, plant and equipment and fair value less cost to sell, lower of the two will cross the border. And on crossing the border, it will be following the principles of IFRS 5. That means the Pakistan rules and principles will be followed thereafter. So IAS 16 property, plant and equipment is India. This middle no man's land is the comparison. After it is decided, whichever is lower will be the new principles, new standard applicable to them. So at what amount it will be recorded non-current asset held for sale? Lower of the two. Carrying amount on existing measurement basis, that is 2,60,000, and lower carrying amount on existing measurement basis is 2,60,000. Fair value less cost to sell 255. Lower of the two, it will be recorded at 2,55,000. And the difference of 5,000 is charged to P&L account. Now there will be confusion that why didn't we reduce it from revaluation surplus? We did not reduce it from surplus because it is not IAS 16 property, plant and equipment. It is moving on to the next standard. So if we are following IAS 16 property, plant and equipment, we'll follow the principles of revaluation model only if something is belonging to IAS 16 property, plant and equipment. But if something is belonging to IFRS 5 non-current asset held for sale, the principles of IAS 16 will not apply to it. Got it? Now the next question arises, what about this revaluation surplus then? You have taken 260 forward, it is recorded as non-current asset held for sale. When we were selling or when we were revaluing, we were de-recognizing or we were updating our revaluation surplus. What about this revaluation surplus? This revaluation surplus will remain in the books until this asset is sold, because we are saying that we are going to sell this asset within 1 year. So when we sell this asset, whenever we do it by next year, we will de-recognize this revaluation surplus also on the date of sale of this asset. Till then, it will continue to remain as part of revaluation surplus as part of our balance sheet. Hope this is clear. Now the asset is recorded as non-current asset held for sale on 30th June. This is a new value. Difference of 5,000 is already charged to P&L. This is a new territory now. New life, new territory on 30th June. Now arrives 31st March. The requirement of IAS 1 presentation of financial statements is that if anything is measured at fair value less cost to sell, or the subsequent measurement in case of non-current asset held for sale is after the date of classification, subsequent measurement under non-current assets held for sale. Subsequent measurement is always at fair value less cost to sell. If you noticed, I have not written any comparison on the date of subsequent measurement. It will be at fair value less cost to sell, no comparison thereafter. So when we reach 31st March, we are required to bring all the assets at fair value less cost to sell, because if anything measured at fair value model, fair value less cost to sell, fair value through P&L is required to remeasure at each reporting date or balance sheet date. When we remeasured, we got to know that non-current asset value on 31st March 2019 turns out to be 269,000. What to do now? What to do now? We'll increase the non-current asset value from 255 to 269 and we'll record it at new fair value less cost to sell, no comparison. We'll not compare it at lower of the two on the date of balance sheet or date of reporting. It will be subsequent measurement is at fair value less cost to sell only. Will not have to be emotional that why the price has increased. It can increase, it can decrease. Whatever happens, the difference is taken to P&L. Even if it increases, we'll take the difference to P&L. Even if it decreases, we'll take the difference to P&L. How much difference to P&L? 9 plus 5, 14,000 credited to P&L this time. Difference of 14,000 credited to P&L. On 31st May, the asset is sold for 245,000. What to do now? On 31st May, asset is sold for 245,000. So we'll record cash account, debit, 245,000. Non-current asset held for sale was at 269,000. Credit, asset, 269,000. Difference, charge to P&L, 269 minus 245. P&L. Any revaluation surplus relating to this asset is transferred to retained earnings on the date of disposal. The revaluation surplus relating to this asset was worth 22,500. So on the date of sale, we'll also pass this entry. The revaluation surplus related to this is debited 22,500 and directly transferred to retained earnings, which you may remember that IAS 16 property plant and equipment said that if there is any revaluation surplus, we have a choice that we can transfer excess depreciation each year, or we can wait and we can transfer the entire balance of revaluation surplus to retained earnings on the date of disposal or derecognition. The same theory or principle we are applying here. It will be directly transferred to retained earnings the day the asset is sold. 22,500. Is this clear till now? There are two things. One, whether the asset is eligible for classification as non-current asset held for sale. First, we need to identify whether it is immediately available for sale, whether the management is intending to sell, whether they're locating a buyer, they're serious about the plan, they do not change the plan. Once it is identified, on the date of classification, we need to bring the carrying amount on existing measurement basis. We need to know what is fair value less cost to sell, we'll compare. After comparison, we'll take the lower of carrying amount and fair value less cost to sell as non-current asset held for sale for the first time in the books. Subsequent measurement on each balance sheet date will be at fair value less cost to sell, no comparison on subsequent measurement. On disposal, if there is any revaluation surplus related to it, also gets derecognized. Is this clear? Any doubt about it? Any doubt about it? Banun, Hema, Nitika, Uday, Pankaj, Sapna. Clear, thanks. What if you change the plan? What if you change the plan to sell? Now here, indirect impairment also is inherent. So we'll recalculate the value of asset as if it was never classified as held for sale. Means what would have been its value as if, what if it was never classified as held for sale? If it was never classified as held for sale, it would have it would have followed normal depreciation principles on cost model or revaluation model principles, depending on what is the choice of the management. Even if you are using revaluation model, then what if this asset was not classified as held for sale? What would have been the revalued valuation amount on the date of change of plan, on the date of deciding to change the plan of selling? We'll compare it with net realizable value. Why we are doing so? It's like reclassifying it back to IAS 16 property plant and equipment will require that this asset we plan to sell simply because maybe it was getting obsolete, maybe because it is there is some factor which decided us to sell it. It was not giving us much benefit. Now, if we wish to bring it back, it becomes mandatory now to indirectly test it for impairment. And how do we test it for impairment? What would have been its value on the date of classification, and what would have been the net realizable value? We compare, and whatever is lower, we bring it back to the situation. We'll bring it back to normal after impairing. If net realizable value was higher, then the asset can be shifted back normally on normal grounds. But if net realizable value is lower, the asset is indirectly tested for impairment and recorded back at the amount which is true and fair. Why I'm using the term indirectly impairment? Because IAS 36 impairment of assets do not cover IFRS 5 and IAS 2 because there is an automatic impairment system within them, because they intend to sell only, they do not intend to use. So there's no applicability of IAS 36 on IFRS 5 non-current assets held for sale and IAS 2 inventories. Is this clear? Is this clear? So this is all about IFRS 5 non-current assets held for sale.